When it comes to risk management, a very important aspect of it is knowing before you take the trade how much you will actually risk on the position. Now, in this video, I will show you exactly how to calculate that risk per trade on all pairs, including the exotic pairs, cryptocurrencies. This trick that I'm going to show you works in any market and you don't need a position size calculator. We will also speak about position size calculators, but I will show you a trick that you can use in any market and on any instrument. Now, if you're new to the channel, I'm a top author on the TradingView platform and I share free education and analysis on all my platforms daily. So I suggest that you subscribe for more free analysis and education, and I will see you in the video. Okay, so first of all, what I want to do is give you this formula that you can use to calculate your position sizing accurately in any market, okay? No matter on which instrument you want to calculate your risk per trade to have a proper risk management on it, you can use this formula and it will work perfectly. Now, the reason for which sometimes you might need it is because what you have basically with all the calculators that you can find online, and by the way, it's full of them. So for 90% of the instruments in the market, you can just Google position size calculator. You just literally Google position size calculator, forex, or any other instrument, and it's very easy. You will just insert the stop loss, how much you want to risk, and it will give you perfectly the lot size that you have to enter to risk a predefined amount of your account that you actually want to risk. Let's say 1%, 2%, doesn't really matter. You can just use any calculator online. However, sometimes those calculators will not work on certain instruments. And that is why you need a formula that you can use on any instrument. And this is basically how it works. You go on your trading terminal, okay? Let's say you use MetaTrader 4, doesn't really matter. What you need to do is enter a test lot on a demo account on the same broker that you have. Why is it important that the demo account is on the same broker? Because different brokers might have a different amount when it comes to lot sizes. For example, on some brokers, one lot will be 100,000 contracts. On other brokers, it might be different. So just to be sure, use a demo account on the same broker to make this calculation. You place a 0.01 lot trade on the demo account of your broker. You place this stop loss where you want your stop loss to actually be in the trade, okay, the real trade that you want to execute. And you just go on the stop loss and you read how much you're actually risking. So you place a 0.01 lot. Let's say you read there that by placing this 0.01 lot with that stop loss, let's say you read that if your stop loss gets hit, you will lose $7, okay? Then what you do? You simply do this. 0.01 is proportional to 7 as X, which is the actual amount that you want to risk. The real lot size that you want to put is what you want to calculate in the first place is proportional to what you actually want to risk. So let's say in the first place you want to risk 100 euros or $100, doesn't matter. This will be 100, okay? So you already know this number here. The only thing that you really have to do is place that 0.01 lot and read what you have when you place the stop loss at the level at which you actually want your stop loss to be. And then you do this. You do that 0.01 is proportional to 7 as X is proportional to 100. So basically 100 times 0.01 divided by 7 will give you the actual lot size. Okay, very simple. 100 times 0.01 divided by 7 will give you the lot size that you have to enter to properly have the correct risk management on any instrument in the market. Now, I have explained this concept. What I want to also do is in this video is give you a full breakdown of the situation that we currently have on US oil because I think it is a very interesting market to follow at the moment for a potential trading setup. Just a quick reminder, make sure you comment below and you let me know which topic or pair you would like me to cover or analyze in the next video. So starting here from the monthly time frame, what do we have? We have a market that clearly has created this overextended M formation. Now, after the overextended M formation, what do we expect? We expect the market to make a move to the upside, and in fact, that is exactly what the market has done. And if you remember, I made a breakdown on US oil when the market was around this area, telling to you guys, look, the demand for US oil is growing. We have an overextended M formation. We definitely expect a move to the upside. Now, it would have been great to be able to enter the market, for example, at $1, $2. It would have been absolutely insane. However, unfortunately, brokers freezed the trading. So I was only able to enter the long on US oil at $5, which was still high. It was still very good. However, we had quite a high swap on the trade, but definitely it's been a very, very, very good return with this move to the upside. But back to our analysis, we have the impulse, we have the correction. Now, if we want to measure this correction, what are we supposed to be doing? Taking our Fibonacci from the high to the low of the impulse. And by taking your Fibonacci on the high to the low, what you can see is that currently the market is exactly at this 0.618 of the Fibonacci taken on the impulse, therefore the golden ratio. That is where the market currently is from a monthly perspective. Going down on the weekly, what we can see. On the weekly time frame, there are two main things that we really have to notice. First of all, we have a very nice W formation. Now, after a W formation like this, so impulse, correction, lower low, and higher high, what do you expect? You expect the market to make a move to the downside and go and test the neckline of the formation, aka the previous resistance, which is now turned support at this area. And the second thing that we can notice is that after starting this move to the upside very aggressively, the market clearly has shown a deceleration now. Very small candles all close to each other. So clearly the market decelerated and we can expect the move to the downside to start and the market to complete the W formation exactly at the neckline. Going down on the daily time frame, what we can see. Now, actually, I want to leave my target clear on the chart. So let me just make it visible also on the daily time frame. And let's go down on the daily time frame and see what we have from a daily perspective. Now, on the daily, it's pretty clear that at the moment, all the structure is still bullish. Why is this structure still bullish? Because you still have the previous resistance, now turned support, holding the market at this level from a daily point of view. We have in fact this previous resistance here, which was again resistance here and again resistance here, which is currently holding as support at this area. And until the market will break the zone to the downside, this will be support. Therefore, we cannot be looking for any shorts. We absolutely cannot be looking for any shorts because the market is at daily support. So how we will be approaching this situation with students? Now, first of all, let's go and give a quick check at what we have from a COT perspective on the CAD. So the commitment of traders, what the biggest banks and institutions are currently doing in the market, so the order flow and how they are positioned. So we have to check the data for the CAD because, as you know, the CAD correlates very well with oil. Now, if we check the CAD, what we can see is that institutions have been selling the CAD in the long term quite aggressively, going from 38K net positions with more longs than shorts. In fact, they had 74K longs and 36K shorts, all the way down to a situation where we have a minus 35K net positions, so a negative positioning with more shorts than longs. In fact, we have 58K shorts and 23K long positions on the CAD. However, in the short term, we can see that we went from minus 35 to minus 19. And in fact, US oil has been moving to the upside quite aggressively in the short term. However, in the long term, we had a clear decrease. So definitely we still have a negative net positioning and there still definitely is the possibility to see the continuation to the downside. So how we will be approaching this situation if and only if the market will actually manage to break below the daily structure, the previous daily support will be turned resistance at this area. And after the break, on the retest of the structure, what we will be doing with students is monitoring price action on the 4-hour time frame inside of this area, because always remember, monthly, weekly, and daily time frame are the best time frames for the direction of the market, but the best time frame for the entry is the 4-hour time frame. So we will be monitoring price action on the 4-hour time frame inside of this area, waiting for the market to provide to us one of our valid entries. And as soon as the market will provide to us one of our valid entries, we will be taking a nice short with a huge risk to reward to the downside, very good probabilities for the continuation to the downside, creation of this impulse correction and impulse pattern to the downside, rejection of the daily structure resistance, which will also be in confluence with the Fibonacci taken from the high to the low of the impulse, and for the completion of the weekly W formation. If you enjoyed the video, make sure you smash that like button and comment below. It really does support the creation of more free analysis and education for all of you. Also, make sure you go and check out the mentorship program. It's a very complete program. You first learn all the rules of my rule-based strategies, and then you trade them live with me each and every day. In fact, I give you a new daily market breakdown showing you exactly how to apply these strategies with the entry, stop, and take profit, as well as answering every single question that you have every day. So I really suggest that you go and check it out, or you can go and check out the next video.